welcome back, and today we're diving into one of the most popular tools used in technical analysis, exponential moving averages, or EMAs. You'll hear them called that a lot. No one likes to type that out. We'll define what they are. We'll talk about why they're so popular, dig deeper into whether they truly hold any value, especially on institutional settings. Okay, so starting with the basics, assuming you've heard of a simple moving average, an exponential moving average just gives more weight to recent prices, so kind of allowing traders to spot trends faster compared to a simple moving average. Actually, let's just jump into we'll jump into the charts. So we'll bring up the EMA. Here's an SMA. And if we really zoom in, so SMA green, right? So it takes the last, and this is a setting of 9. So we'll take the last 9, equal it all out, and we're right there. The exponential gives more weight to the front side, which is why you see these red candles right here. All I'm on is the S&P 4-hour chart. But you can kind of see it's already turning down. We'll talk about visuals here in a second and why that will be important later. Because if you just thought, and I've heard people say this, which way is the EMA pointing? Draw an arrow at the end of the EMA. And sometimes visually that can be super easy. But if I were to draw an arrow at the end of this SMA, we'd be moving up. And you might think, hey, it's time to just keep buying. This could be a good dip buy. So while we're on the screens here, some popular ones, I already loaded them up. So we're going to get rid of the SMA. Actually, we're just going to junk that. So we have the 9 EMA. You've actually heard me talk about this one. This one's actually a default on TradeStation. So it's kind of the one I see all the time no matter what. You have the 20 EMA, the 50 EMA, the 100, and the 200. And we can zoom out so you can see all of these. There they are. There's all their lines and all their glory. There's the laser show we all know. And there we go. Now we're talking. What does all this mean? Okay, so starting from the top, the 9 EMA. So this is a very short term. You were probably not on the 4-hour time frame with this one. So favored a lot more by day traders who need to react quickly to price movements. I've already said this a little bit, and then you're going to hear me just kind of repeat the going theme. These are a visual aid. Okay, all this is very simple math. If you ever watched my live streams, I've even said, right now we're probably a little carried away from any EMAs, whatever popular one someone's talking about, or we're scrunching them up. You've heard me reference these get strung out like a slinky, kind of like how this looks right now. But again, these are very visual forms of help. The 20 EMA, we got the blue one right now. We're bouncing off that thing right now. So this is a short-term indicator often used for swing trading. So gives traders a good snapshots of a stock's kind of recent trend. Puts a little wiggle room in there, a little breathing room. Let me just start by saying this, because you're probably thinking this is very weird, the fact that I'm even going over indicators at all, because I never have them on screen. And it's not that I don't care for them. It's that I'm human sometimes. Sometimes I'm not a robot. And when these EMAs work, the more it works, the more I tend to just forego what I think about the market and just let's do the EMA thing. And then I just start losing. So that's why it's a big thing for me that I don't have indicators up. I've been doing it for 11 years. We're about to hit the 12-year mark. There's just not a lot of EMA action that I truly need. Anyway, so this is not a joking video or an O&R video. Jumping back into it, every one of these has every EMA I have up here. There are certain indicators people ask me about, and I do laugh. I laugh a little bit, not to be mean, but it's kind of funny. Every one of these you see on screen, there probably is a time and place for it. So the 50 period coming into that a lot. So this one's kind of like that medium term. I don't know how much this really offers. It helps identifying the overall market direction. I get it. That's what people will tell you. But we might really be spilling. You're kind of awkward in that mid spot. So should you be buying the dip? We haven't really sold off, and we might just be getting into a sell-off. When you start breaking the 20 right here, some people will talk about the 50 as in here's the one time it bounced right here. But sometimes by the time we get that, we're really we're really sending it. So I think breaking the 50 EMA is probably more important for me if I just haven't already been short. I'm a trader, so this makes more sense to me as a trader than it ever would investing. But anyway, the 50 is kind of the has its place. But as far as like, should I buy the dip? It's bouncing off the 50. That's going to go lower on the totem pole. The 100 pairing movement, EMA, sorry. So think of this like the balance between, I guess, noise and a signal. You're kind of at that dip territory. We haven't seen this in 100 days. Kind of like we're getting down there. So this is the 100 moving right here, and it did kind of. This is the beginning of September, right? The super red month. Historically, September is supposed to be red. Just ignore all the green candles. Another video on about that later. But you kind of got this. This one got devastating. Let's pull back. Just destroyed it every time. Here's a bounce. And what I'm getting at also is how you can abuse these very much by tricking yourself into thinking they work. Because here's a bunch of 50 bounces right here, and someone will be in the comments like, "I play the 50 all the time," and it bounced here, 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 and here. Like, that's cool, and it just got wrecked there. These are not the end all be all by any means, and that's probably the most important takeaway I can ever have talking about moving or indicators in general. Is like, hey. Visual indicators, these are helpers. These are, you have your basis for thinking something. This is all right, let's tilt the scales a little bit. If I'm stuck at a 50-50, maybe this can offer that 1 point, 51.49. As far as the 100 bounce, it's not as popular as the 200. I would look at that as the overall trend, I think. I've heard of a couple institutions that they worry about the 100, and that is just as far as a parameter for an algo, like is it above or below? And that's really all they're looking at. They're not looking at, are we going to bounce on the 100? Are we going to do anything like that? It's where do we stand in relation to the 100? Have we been trending up or down? Because if you're dancing around it, the answer is neither. Now the 200, that's definitely a long-term trend line. Now, I've definitely heard more institutions using this or having this as a parameter than anything else. Some popular YouTubers talk about it as well. And like I just said about the 100, stands more so for the 200. Stock above the 200 EMA, often considered an uptrend, while below downtrend. Now, what that would mean is if we're pulling back, we're still above this. You're still in the uptrend. We're still in the dip buy territory. We're still looking for that dip buy. That's kind of how someone would look at this. There's many strategies about this as well. One of them is actually we'll cover it. It's called the Golden Cross. We'll have to get to the daily time frame on that. Let's talk about why I picked these first before we move on any further. On top of Google. I'm just kidding. I did not Google these EMAs. These are all EMAs I've heard people talk about and get brought up often. Outside of one YouTuber, I wouldn't say Ricky Gutierrez. He's the only one I think that ever talks about the 180-day moving average. Maybe switch to the 200 now. But other than that, I've always heard the 200. So the difference between the 180 moving average and the 200, I would say very slim to none. Now, outside of that, the reason why some of these have the power they do is because their popularity in itself. Okay, no one's worried about the 43 EMA bounce because no one's watching that. Now, by just shedding light to some of these EMAs, hey, the 9's popular, the 50's popular, and then YouTubers, there is a mass audience out there for it. And I know people think retail is not that big, and it's not, but it is a lot. Retail, if they ever got their stuff together, they could move markets. They are big enough to do that. They just have no idea what they're doing, and there's too many chiefs to that tribe. So probably nothing you'll ever worry about. But what I do as far as me being a trader is I look for buyers and sellers, and I do know, hey, these are popular, which does bring a branch of buyers into my pool. For me, I might be trading zones. There's a lot of other things that I do, things that I like. So does everybody else like that too? They have no idea who I am. I'm still a very small channel. I've been doing this for years. I'll probably never get a bunch of subscribers. But as long as they're there, as long as some other dork out there told them, hey, that's the one, and they're going to go ahead and buy it off that, then that's buy-side activity for them. That only helps me out. So popularity there. Let's talk about the golden cross. This is when the 50 EMA crosses above the 200. So we're going to have to go back for a little bit on this one. We're going to minimize the 100. No one needs that anymore. So we got the 9, the 50, and the 200. There's the golden cross and the death cross. Let's see. So what you're looking for is, where's our last? Okay, here we go. We start to really trend down. So here's your 200. Now right here. Let's get a little circle. Let's zoom in on this bad boy. Let's move the circle. There we go. All right, so right there, you guys can see it right there at that cross. Now that would signal a bearish trend, a time to go short. Can anybody else see the issue with this? This is why I don't like these plays. And again, try to remember, even as anyone makes a lot of these how-to videos and tutorials, and they're not going to show the other side of how things actually work. They're just going to show the picture perfect. You can learn most of this on a pamphlet, not worth buying a course over. But here's the death cross. Time to go short, right? That would have been a good time to go short right there, but that's after the close. So this would have triggered right around here at the close of this candle. So that's when you're going short. We've been in a downtrend for some time now. That's a problem. Even if you were going short right here, this would have panned out because you would have went short at the peak, and then it would have gapped down. And you would have played the trend. You got about half the meat on the bones there for the trade overall before it bounced again. And who knows how you manage or get out of these things. Nonetheless, when the 50 crosses the 200 to the downside, death cross. And then when it crosses to the upside, that's the golden cross, which means it's time to go all in long right there. And if you did that, well, you were down for a little bit, so hopefully you didn't panic out or anything like that. But if you did it again when it did it on the other time, right there, hey, now we're talking. There's another golden cross. The only downside is you probably, hopefully you didn't go short right here. Let's zoom in. Let's get the refs on this one. We went flat. We had a death cross for a few days, as a matter of fact. We're flat lining across this thing. There is a DNR that they just did not pay attention to, and they brought it back. So we got a death cross for a few days, and then a golden cross right after. Again, all that really signals is that this is just not the end-all, be-all, but the overall trend of things. Personally, if I was thinking the death cross was coming, you would probably already see this thing trending down. We're headed that way. It's about to get there. Then maybe I'll go short, and hopefully that signals a bunch of others to go short as well. But there's plenty of examples of just using these in itself. I've already brought up one as far as throw up an EMA in there. Do an indicator, a value of every 5. Do the 20, the 25, the 30, the 35, the 40, and then when it looks like a stretched out slinky, then it's probably time. It's probably a little extended. There's one other thing. I guess we could take that down into a smaller notch because I know it's about to show up in the comments. Let's talk about the 9 and the 20, but for that we're gonna probably have to take the 200 off. Let's go to a smaller time frame. Let's go to the 15. Probably a more of an intraday thing. This one I think could carry a little bit more weight as far as trading. This is something I would probably try to adapt if I was trading futures. Visually, I don't mind the 9 EMA when you're on the 15-minute time frame or smaller. If you haven't been babysitting or looking at it all day and you just can't tell which direction the candles are going, up or down, then you could put the 9 EMA on there and bounce. If it's been trending that way all day, like for this one right here, here is again, the 9 EMA is the light blue, right? So we're trending down. Green candles, but never broke above. So why are you worried about buying it? You're not. You're just going to keep going short. Same thing here, same thing here, same thing here. It never actually broke. It finally got broke, and then well, finally it did break. And then you could have gone long somewhere in here. You would have flattened out. Would have been better than trying to go long every one of these other times. So by adding that extra little golden cross, death cross value to it, by waiting for it to at least cross the 20 EMA, kind of keeps you from getting into stuff like this where it does just chop and dance around. And then, power hindsight, you look back and just realize, well, that sucks. You were just in a bunch of chop. You almost don't need the EMAs when we have trending days, and that's another dangerous thing about videos that show the how-to of just follow this indicator. But again, I would say this is a pretty popular strategy as far as a little baby death cross, a little baby death cross, a little baby golden cross, all the same thing, same concept, right? So why are these so popular? Okay, and I've already said most of this. It's easy to calculate, easy to interpret, which is why it's their favorite for beginners, because they can't wait to just put something on their charts. They look at these candles like, that's not cool. I got to look like somebody else. There's got to be a laser show. There's got to be bubbles. There's got to be little globes on there. I've seen candles coming off the right side, sometimes even the left. We got volume bars at the bottom, but those are candles as well. We got to put some lines on there. Beginners love to just toss stuff on there. This is so easy. I could teach this as far as I could put all this on a pamphlet, and you got it figured out. This is, in fact, the longest version of a video you'll ever need for an EMA in general. Visual tools, as far as, again, we've talked about this being just so visual. It is a very clean signal. Whether they're crossing over or seeing how it reacts at the line, it kind of gives you a cool place if you guys are brand new. More importantly, if you have the right way to manage risk, then this isn't bad at all, because the only question you need to ask yourself is, okay, it's coming down to this EMA, whichever one you pick, whichever time frame you're on, and it does need to match your time frame. I probably wouldn't be doing the 9 EMA on the daily. You could, whatever. The question is, where are you going to stop out if you're wrong? Okay, it's not going to bounce. Where's that at? And if you can answer that question, then you at least have some structure to the trade and a reason. And I would put that far above hopping on Wall Street Bets or Stock Twits and just reading what somebody said in the comments and just going for it, just blazing, just shooting from the hip. The crossover strategies carry way more popularity than I have ever cared to wonder why. I wonder why, because by the time it does cross over, things have already happened. We're already almost there. And so this crossover happens by the time these candles close down here somewhere. So the examples I've shown you so far, had you played the crossover, it would pan out. And again, I want to stress this because I could go through this chart and probably find a million times where you would be shorting at the bottom, going long at the top. And it's one of those, if you're going to front run that risk, do you need the crossover? But nonetheless, just keeping it at the basics. That's just, I have to put that disclaimer every time. But the crossover is kind of an easy thing because it again kind of just puts the pro and con is an extra layer of, is it going to bounce? Was it not as strong as a pullback or a downtrend as you thought, and then it did turn around? Why I call that a pro and a con, and I've sarcastically made a video about this. You just toss another EMA down on there, and then you just add on at every EMA. That's all you got to do. You put the 20, the 25, the 30, the 35, the 40, the 45, the 50, right? And every 5, you just add on. If it bounces at the 50, kablam! As long as it goes back up, you're good. So as long as you didn't pick Peloton, Neo, anything that just went away, TVIX, UGAS, moment of silence, UWT, DWT. You guys remember those? Amazing. Anyway, as long as you didn't pick that, you're killing it. So what I would say is, if you're hearing this, and you're going to draw some EMAs out there, and you're going to put the laser show up there, define every one of them before you put it up there, and then there's no changing it. Because you start changing, you start giving yourself reasons why you're in a position. You're just selling yourself a position, and you're no better off than just running and gunning, you know? Okay, so to talk about institutional trading, 'cause this is what everyone loves to argue and talk about. So do big firms actually use EMAs? They do sometimes, but not the way retailers do. You heard me mention this before. Sometimes it's a parameter in an algo, and that's it. It's a quick visual. They're not worried about the bounce. They're not trying to time. Did it touch the line? Did it come close? Did it come close to the line? Did it reject? Retail will look at this and try to break it down like it's the Bible code, and it's not. It's a line. It's simple math. There's nothing to it. They'll use it to maybe justify trades. You want to buy or sell a stock. You can point to the EMA and explain your decision to your managers. Hey, we're at least trending up. I don't know. It's about all you got out of that. I know people have done. I've heard of institutions doing that, but again, it's just that visual. That's really it. I think a lot of people hear an institution uses it, and then they're like, that checks all the boxes I need. Institutions use it. I want to trade like an institution. I'm going to do it. But what they do is something completely different. These are very useful confirmation tools, but not the decision makers. I know we've already gone over this, but they're just used to confirm kind of what you're already thinking. Again, as a multiplier. So now for the cons. The why I would just be careful having these. I've told you all the reasons why, and the examples I've shown you is so far they actually would have worked out. I encourage you to take some time and put it up there, and not to never do them. I fully understand these, and let that be clear, guys. I fully understand these and have seen these. Okay, what I would encourage you to do, even if you're never going to use them, fully understand them. Again, even if it's just to know how they work, it's just part of the market. They're popular. They do bring in some buyers and sellers with it. I don't want to say they're completely overrated, but there is a lot of cons with them, right? They're lagging indicators. They're always reacting to the past, right? Things need to close for that little line to move, which means things have already done. So by the time you get the signal, it's already too late to act. Again, the examples I showed you, it did pan out. Go run away with that and be happy and watch what happens to your account. Because I can tell you right now, it won't do what you think it's going to do. False signals. Remember, I kind of mocked and made fun of it where it was a death cross for 3 days. It was flatlining. We're on the bed. We had to bring in the crash cart. You think something's about to happen, and then it doesn't happen, which again leads into why if I think the 9 is going to cross the 20, I'm probably already short for some other reasons, and that just confirmed it. And hopefully some other, someone else that uses these is probably piling in short, and that only helps me out. More sell side activity. Sometimes they're a self-fulfilling prophecy. They work simply because enough traders are watching them in the same indicator. I don't want to say that it creates an artificial support and resistance. I know that argument has been out there. You can call it whatever you want. I don't care why it bounced. I just know that I bought the bounce. Okay, so I have more of an income bias. I don't really care why. Sure, it bounces off my yellow boxes all day, all the time. But you could say it was because of news. You could say it was all a coincidence. You could say whatever you want. As long as I made money in the trade, I don't really care. But I've heard that argument a lot. They do give off the illusion of simplicity. And you think you can just, all right, I see the candles touch that, time to go. And I think that gets a lot of people in trouble because they're going to jump in, they're not going to fully understand it, and then they're going to lose money, and then they're out. They're the next batch of people that just say stock market's a scam. And that's why they're not going to make it 5 years. They offer these clean-cut signals in a world where it's still humans. This isn't AI. And I know everyone's worried about the algos. It's not AI, right? It's just a math problem, a little more complicated math problem. That's really all it is. But if I can teach you an indicator on a pamphlet and tell you to buy here or sell here, then that's just not how things work. It's not how things are going to work. Now, I can show you visually how many times it did, but I can search and find so many more times where it didn't. So you start leaning too heavily on these EMAs, your account will reflect it, and you probably won't be around next year for my next video talking about an indicator. Hope it doesn't take me a year to make another one. It also, I will say, it does give me a heads up as to how much somebody knows or doesn't know, because you can always tell when someone's brand new. They often come up and they tell you, I'm new, I can't tell, I have no idea what's going on. It's like you're speaking gibberish, okay? But then they've taken some breadcrumbs off the plate, and they've learned a big word, stochastic. You know, they've learned exponential moving average, EMAs. Now I'm speaking the financial code, and so they come up. They can't wait to tell you and throw out these words like a parrot that has no idea what he's saying but knows the word and can physically say it. So a part of these, it just makes people sound smarter than they actually are, but only to the people that have no idea what they're doing. But anyway, I'm going to wrap it up here. As far as I'm sure my thumbnail and title is my favorite indicator or something like that. If I had to pick one and only one to ever trade, it would be a tough. I don't really care about the 200. I will say the amount of times I will watch the 200 versus the 9 would be black and white. So if I could only pick one, 200 would be cool. Because I know at a deeper level, right? The higher the time frame, the more the buyers and sellers are looking at that. So I think that one might stand to hold up. It could carry a little bit more weight. But I think it would be the 9. I wouldn't mess with all the necessary stuff in the middle or unnecessary stuff in the middle. You know, the 50, the 100, like we can draw the slinky lines out and you can say what you want about them. I personally don't care. I like the 9 intraday. That is a great visual, and it's nothing I even ever set out to do. It was just it was a default on my trading platform, and I just quit deleting it, so it would just keep popping up. And I would just notice if I'm trading when markets get choppy, I tend to get into the futures realm. A little bit of leverage, but it's not so spooling up like a turbo, like an options contract. Easier to play the in and out game, super liquid. But I would just see how many times that 9 EMA, we would just hit that and bounce. Okay, for whatever reason, I have TradingView up right here. When that hits a zone or something, then I'm ready to go. I open up TradeStation, and there it is, bouncing off the 9 EMA. I'm like, that's crazy. I think I could probably do more with the 9 EMA than I could the 200. Although it comes to a battle of capital allocation. If I could only ever play one indicator, and that would be it, and I could never see or know anything about the other one, we're talking $2,000 on the line for the 9 EMA, $200,000 on the line for the 200 EMA kind of thing. So one would be one would be throwing jabs, the other one would be throwing haymakers. I guess you'd have to depend on which one. I really wanted to have, as I was making this, an idea of which one would be my favorite. But I just don't. I think, again, I'd have to stick with the 9. The 9, super easy. I will say the 9 probably gets overlooked. If you are a beginner and you need that visual aid and you're just learning price action, it's not the end-all, be-all, but look at it, okay? And this is it. This is how you play it. There's no course to buy. There's nothing. I don't even have indicators in my course. I teach price action and everything else. But look at it. Smaller time frame, 15. I'd probably say 15 or 5. No offense. You're under the 5 minute. That's a lot of noise. Is it trending? Okay, I mean, we're just going one way and we haven't even tested it, or maybe we have, and we just bounce, and we just stay on it. Or are we just look at the last hour? You're on the 15-minute time frame, last 2 hours, last hour. How many times does it cross the 9 EMA? That's choppiness. Stay away. Trending. Get on that trend, and that's it. If you were a brand new trader and you just did that, I actually think you would do pretty well right out of the gate. You'll be able to fine-tune it a lot later, but if there was something like for a beginner to use, and this is not actually even a beginner strategy, it would be the 9 EMA on the 15-minute time frame. I think that would be my final answer to which one would be my favorite. If I was in a car accident or decided to play football one day and I didn't have a helmet on, right? and just took a hit to the head, forgot everything, it would be the 9 EMA. I think that I would want to start over with. Let me get used to the flow of things, get used to the price action. I'm gonna wrap that one up here. So anyway, wrap that one up. I'll try to do other indicator videos. I'm known for making fun of a lot of indicators, so these will be all very real. But let me know what's another popular indicator you want me to break down, and just kind of unbiased go over, whether it's good, bad, what it could be used for, how it really does hurt people. Let me know in the comments down below, and I will see you guys in the next one.